Lecture, and will really need probably no introduction from them for the vast majority of you, but I want to introduce her nonetheless. Anne is the Director of Policy Research in Macroeconomics, Prime. She's a Fellow of the New Economics Foundation and indeed a member of the SPERI International Advisory Board, and we're very grateful that she is. She's a leading authority and commentator on economic affairs, ranging broadly from topics like international finance, sovereign debt, and indeed macroeconomics. She's perhaps best known for her leadership of Jubilee 2000, the worldwide campaign to cancel over $110 billion of debts owed by 42 of the poorest nations in the world. Indeed, the debt cancellation for Nigeria was the largest for any single country. She's the author of a number of works, but perhaps most significant in this context, in 2003 she published The Real-World Economic Outlook, in which she accurately predicted the seismic crisis and the bursting of the credit bubble, and indeed suggested that the bubble would burst first in the US. In 2006, equally presciently, she published The Coming First World Debt Crisis, and she's been described by The Ecologist magazine in 2009 as visionary for her work on the Green New Deal.
I paid a lot of money for that.
Well, absolutely. And since...
we went deeply into debt.
Nice one. And since, by the Times newspaper, as a member of that select club, the seers who saw it all coming. She's going to talk to us this evening about industry, finance, and the ecosystem. What relevance for LIBOR? Thank you very much, Anne.
Thank you very much, and it's awesome to be here, as the Americans say, in this very distinguished audience, with this distinguished audience, and I'm very honoured to be part of this new Sheffield Political Economy Research Institute. And it's also a really wonderful time to be working in this field. I haven't had so much fun for a very long time, so much entertainment, if you like. The British establishment has been entertaining the people in ways that are unknown to us, really. Watching Robert Peston knife Paul Tucker, and then watching Bob Diamond knife Paul Tucker, and Paul Tucker knife Bob Diamond, and so on. I mean, this is real classy entertainment, and it's been extraordinarily interesting to watch. But also, for me, incredibly salient, because it is about what I think is one of the most important policy instruments in the economy, and that is the rate of interest on a whole spectrum of loans, LIBOR. And so I want to talk about that now. I'm not an academic, I want to stress that. I'm an activist that has come to the whole question of the way in which the international financial architecture is built and the way the system works, that came from it by working on the periphery with very heavily indebted countries and trying to understand why before 1970 they never had foreign debts, and why after 1970 they built up these massive debts. And so that's, I spent 3 years at the New Economics Foundation at the end of the Jubilee 2000 campaign to try and understand why it was that this had happened. Everybody had said the oil crisis, but really had very little to do with the oil crisis. Had much more to do with the liberalization of credit creation and globalization, of course. So this is where how I come at it. So this is not an academic presentation. I just wanted to say that to start with. I want to start with the words of wisdom of a man who has been of enormous importance to the global economy, Mr. Alan Greenspan. Knighted Sir Alan Greenspan, knighted by Gordon Brown, no less. Against, if I'm not mistaken, the laws of the land, because he is an American after all. He said in an article in the Financial Times on the 4th of August 2008 that the past decade has seen mounting global forces, the international version of Adam Smith's invisible hand, quietly displacing government control of economic affairs. He said with a sense of great satisfaction. Since early this decade, central banks have had to cede control of long-term interest rates to global market forces. The danger is that some governments will endeavour to reassert their grip on economic affairs. And I'd like to suggest that that is a danger that is imminent. But this point that he makes, which is that central banks have had to concede control over long-term interest rates to global market forces, for me, is the crux of the crisis, the financial crisis that we're in, and of the failure of academic economics to understand the nature of money. So what we've had under globalization is the privatization of rate setting by who? Well, we discovered in these last few weeks that the rate setting is determined not by distinguished economists, but by people that call themselves submitters or traders in the back rooms of Barclays and other global banks. And the consequence of their control over long-term interest rates is most dramatically shown in 2008, when the Federal Reserve effective federal funds rate was being dramatically brought down by none other than Sir Alan Greenspan to deal with the crisis, while simultaneously our submitters in the back room were doing this to people with mountains of debt and bankrupting them in the process, and probably making some capital gains too. And that's most explicit in this chart that was produced by the IMF in 2009, which shows the gap between real private borrowing rates and the short-term rate, basically fundamentally the base rate set by the central banks. And you can see that banks are borrowing from the central banks at this rate and lending at this rate. And of course these are average rates which the IMF has enough clever people to be able to calculate. But this is a vast gap, and the possibility of gain here is massive. So, and here we see at the height of the crisis, when the rate needed to come down, that actually it was being pushed up. And this is the rate that people in what I call the real economy, the economy of ecological assets, physical assets, human assets, that this is the rate at which we are trying to borrow in order to engage in sound economic activity. And what this shows us is that central banks are impotent, as Mr. Alan Greenspan argued, and irrelevant to these rates, virtually. You can see how irrelevant Sir Alan was at the height of the crisis. Because very few people, of course, in the real economy are borrowing at that rate. But there is a role for the central banks, and they've exploited that role extraordinarily in this last period, and that is their role in money creation. Now, I do love the Americans. You know, a lot of the exposure that we've got around LIBOR right now, a lot of what we're hearing about the relationship and the discussions between Mr. Mervyn King and Alan Greenspan and Angela Knight is coming to light because of freedom of information in the United States. And this is the first televised interview given by a governor of the Federal Reserve ever in 15th of March 2009. It was a day or so after Mr. Bernanke had given $160 billion to AIG. Now you will know that AIG is not a bank. It's an insurance company that gambled really crazily raising money, and they've got itself into very deep trouble. And overnight, Mr. Bernanke enabled AIG to have access to federal funds, and overnight produced $160 billion for AIG. So the journalist says to him, now where did you get this money from, Mr. Bernanke? Was it tax money? And Mr. Bernanke says, no, it's not tax money. The banks have accounts with the Fed much the same way that you have an account in a commercial bank. So, to lend to a bank, we simply use a computer to mark up the size of the account they have with the Fed. So overnight, the central bank was able to create $160 billion for a non-bank that had just suddenly joined its system. And we know from, again, thanks to American transparency and accountability, that the government's accountability and the Government Accountability Office had produced these numbers. $16 trillion was created by the Federal Reserve in financial assistance. It's not clear what that is, but of course that includes guarantees as well as deposits to some of the largest finance. $16 trillion is what the GAO calculates the Federal Reserve created. We apparently created less. Mr. Mervyn King has told us that we spent at least £1 trillion, a whole year's income, in propping up banks, and he then makes his famous speech about never in the field of financial endeavour has so much money been owed by so few to so many, and one might add, so far with so little real reform. But as Mr. Mervyn King is one of the reformers, that seemed to be pretty self-critical. So what we know from this experience is that in a monetary economy, and I've just been having a debate with one of our colleagues in a coffee shop, in a monetary economy, there is never a shortage of finance. Never, ever. In the US, the UK, Japan, with nationalised taxpayer-backed central banks, there need never be any constraint on the availability of finance. And that is what is so glorious about our financial systems, about our monetary systems, about our banking system. There need never be a shortage of money. And if there is never a shortage of money, I argue, the price of money, or the rate of interest on money, should always be low. Now this is, you know this, I know this, the public is getting to know this because the public's never imagined $16 trillion before in their lives, but suddenly these numbers are appearing. But of course this has been the case since 1694, since the founding of the Bank of England. There's never been a shortage of finance, and thank God for that. But our politicians don't share that view. You will recall that one Liam Byrne wrote to the new Chancellor saying, "Dear Chief Secretary, I'm afraid to tell you there's no money left." And the Labour Party, I think, still believes that there's only a limited amount of money with which the government can play. But not just the Labour Party. The Chancellor has told us that the British government has run out of money because all the money was spent in the good years, he says. The money and the investment and the jobs need now to come from the private sector. The government, he says, has run out of money. And we know the government need never, ever run out of money because the Bank of England is a government bank. It's a nationalised bank. It's owned by the government. It talks about being independent. It's far from independent, not in the least bit independent. And Mr. Miliband talks in the same language. There's a lot we can do even when there's less money. And this all dates back to this old age notion represented by the old lady of Threadneedle Street, that money is a tangible quantity. This is the famous cartoon by James Gilray of William Pitt the Younger, more or less, raping the old lady of Thread in order to get his hands on the gold bars in this chest, which is the money the banks create, apparently. And this myth that there is a chest of gold that is limited and that the Bank of England guards it feeds into all of our thinking about money and credit. But we know that there is no tangible quantity corresponding to the aggregate of bank money in the economy. It ain't there. We can't measure tangibly the quantity corresponding to the aggregate of bank money in the economy, because it isn't tangible. The money that is tangible is tiny. It's a very tiny proportion of the money that we use on a day-to-day basis. And I think that's a rather wonderful thing. I'm rather glad that our money is not a commodity-based, many neoliberals think, is not commodity-based or in any way linked to a commodity. It never was. Even in the days of the gold standard, there was no limit to the amount of money that could be created that was defined by the amount of gold that was in the vaults of the Bank of England. They pretended there was a link. There was talk about the link, but there was no real link between the commodity, the asset which was buried in the vaults of the Bank of England, and the amount of money creation. Now, our monetary system owes a great deal to this man, whom I'm a great admirer of, John Law, and who is demonized in the literature for the role that he played in supporting the Duke of Orleans and his role in the South Sea bubble and so on. But John Law was a genius and understood money in ways that today many economists and many bankers don't. What I love about his book is that it's called Money and Trade Considered, with a proposal for supplying the nation with money. And this proposal is the way in which bank money is invented and used to increase the quantity of money in the economy, and which at the same time led to a lowering of the rate of interest. As the quantity of money in the economy was increased, the price of money fell. And that was one of the great civilizational advances in the British economy, the European economy. It removed control over lending by rentiers, by those who hoarded a surplus and agreed that they might lend a bit of the surplus they'd hoarded to some entrepreneur who had a big idea, who raided and ravaged and rampaged around the countryside and exploited others in order to accumulate a surplus, and then lent it out at a very high rent. That process was destroyed by the invention of bank money, and the way in which John Law and others thought about bank money and made it practical. So they increased the supply of money and thereby lowered its price, the rate of interest. And Karl Marx was one of the few to recognize what that process was. He wrote in his Process of Capitalist Production, a critique of political economy, the development of the credit system takes place as a reaction against usury. This violent fight against usury robs usurer's capital of its monopoly by concentrating all fellow money reserves and throwing them on the money market. So Marx understands was that the invention of bank money and of banking systems and the role of the Bank of England defeats the usurer, defeats the hoarder of money, defeats the elites who hold on to the nation's surplus. So I think there are great virtues in bank money, that there are it's a great civilizational advance. I work in Africa. I've just come back from Nigeria. People routinely walk around Nigeria with $10,000 in their pocket. They have no confidence in their banking system. They don't use checkbooks and they don't have credit cards. They use dollars, cash, and naira. And they walk around with that money in their pockets. They deal mainly in cash. We tried to pay our hotel bill by credit card. It was impossible. We tried to make a bank transfer. That too was impossible. So the banking system doesn't work in Nigeria, and that hinders the development of Nigeria, despite the fact she has extraordinary wealth. So bank money and a bank system is a great civilizational advance. It's made, and as John Law argued, it made trade possible. It financed the welfare state in 1945. It's been used to finance wars. It's been used to avert financial crises, as we saw in 2007-9. But above all, its greatest virtue is that it lowered the cost of borrowing. But it has other virtues. We know that we have enough money to tackle climate change. I work with many green organizations. Everybody's always worrying about where will we get the money from to transform our economy away from one based on oil to one based on renewables. That's going to be incredible. Where will we find the money? There will never be a shortage of money to finance the transformation of the economy. There may be a shortage of skill. There may be a shortage of labor. There may be a shortage of ecological assets. There may be a shortage of fish in the sea. There may be a shortage of clean atmosphere. But there will never, thankfully, be a shortage of money to finance that. There's enough money to eliminate global poverty, to create full employment, and to create and enjoy works of art. As Keynes once famously said, we can afford what we can do. We can't afford more, but we can afford what we can do. Whatever we can do, money can make that happen. And the great thing about the British Industrial Revolution is that it came out of the invention and the sustaining of a banking system, the Bank of England. It is the thing that enabled Mr. Watts to finance his steam engine. Can you imagine? It took from 1763 to 1775 to develop, 12 years. He would have had to have finance for that. It was a really risky project. I can imagine people not believing it would ever work, not believing it would have any usefulness, not believing that anybody would build railway lines for this thing. You know? And why would you give them money for that? But because we had public banking system, he was able to get money to finance that. And I argue, that it was the money system that enabled the Industrial Revolution to happen. So money is a free, intangible public good, and the rate of interest, the price of money, therefore, is a social construct. It's not the result of market forces. It's not the result of supply and demand for money. It's not, as we have seen so clearly in these last few weeks, the price of money, the rate of interest on money, LIBOR, is determined by individuals within the banking system and working within that banking cartel that is known as the British Bankers Association to agree on the most appropriate rate of the time. And I have some sympathy with Bob Diamond. I have some sympathy that he was trying to protect the reputation of his bank. I have some sympathy that Paul Tucker was concerned that interest rates were too high when he knew that Britons are the most indebted people on earth. That companies, individuals, households had enormous debts, and that if LIBOR was not managed down, then this was going to affect, as we know, $300, $500, $600 trillion worth of assets. And so that concern was to manage that process, of course, is, in my view, in one sense, wholly honourable, but we know that the Barclays bankers were also doing it mainly in their own interest. But that is how the rate of interest is determined. At central bank level, a committee of men, and they're always men, sit around a table and determine what is the most appropriate base rate, official rate, for that economy. And considering not just the finance sector, but also industry, what is the most appropriate rate for industry, and for labour, what is going to create what is most beneficial for full employment. Now, that's what bankers should be doing. The mandate, the Fed's mandate, is to consider full employment. Unfortunately, the Bank of England's mandate is much narrower. But the point is that decision to lower rates is a social construct. It's made by people, and it's not a result, because this thing, which is money, is intangible, it's not a commodity, it's not linked to a commodity, it never was linked to a commodity. So G20 economies are monetary economies with well-developed systems and taxation systems. And we all understand that the acceptability and the validity of bank money is due to it being able to facilitate transactions. And so therefore, the price of this must always be low on this free, intangible public good. Now, of course, whenever I make this speech, I'm immediately attacked by the inflationists who argue that, create too much money and you get inflation. And absolutely right. If the system, both the public and the private banking system, creates more money than is the potential of the economy, then that will lead to inflation. The simple thing of too much money chasing too few goods and services. So, if we create more money and more economic activity than the ecosystem is capable of, that too is unsustainable. If we create less money than the economic potential, then we get deflation, which is what we're faced with right now. Today, the inflation rate has fallen dramatically. Everybody's terribly surprised. They should not be surprised. It's because of the contraction of credit in the British economy. So you get deflation or inflation, which are evils, which have to be managed as a result of the creation of money, which is why money creation has to be managed and regulated. So there are limits to money creation. Money or debt created must correlate to economic and ecological potential of the economy. It must be aimed, in my view, at sound, productive economic activity in order to generate the income, wages, salaries, profits, and taxes with which to repay the debt when the money has been to the banks who have created the money. Because, of course, by creating the money, they create liabilities for themselves. So the money created should create the income which would help to repay the debt. If that is not the case, if the creation of credit exceeds the economic potential of the economy, then the rate of human exploitation becomes intolerable and the extraction of ecological assets becomes unsustainable. Think of Brazil. Brazil borrowed crazy money and then had to repay it, and had to repay it in a hard currency, in foreign currency. So she began stripping her forests. She began, stripping the Amazon forest. She has to accumulate assets, and they invariably are human and ecological, with which to repay these huge mountains of debt. So there's an ecological dimension to it. So and then of course people, we have the situation where we used to be able to work 5 days a week and 8 hours a day. We now have 7-day weeks and 24-hour days and so on. So the rate of human exploitation has to rise to repay exponentially rising debt, and that will become intolerable. So finally, as of now, economies become burdened or deflated by vast unpayable debts, and we have a crisis. So that's why money creation and fixing of the price of money is a vast power, and that's why it must be regulated in the interests of society and the ecosystem. So what we've done effectively is to limit money creation to the private sector. So the public sector will create $16 trillion, but that gets channeled through the private sector, and the private banking system then lends into the real economy. And not only do they lend on the money that originates with the central bank, but they also fix the price of the money that they lend. I mean, this is totally, the way I think about it is if I was growing tomatoes and I also had the power to fix the price of my tomatoes, I'd be in heaven. Right? This is not quite tomatoes, these are not like tomatoes, but this is the powers we've given to people called submitters and traders in the back rooms of bargains. So they act in the interest of their own interests of bankers and speculators, when actually we require them to act in the interests of the real economy as a whole and to subordinate the interests of the finance sector to the real economy. So the history of financial crises, credit bubbles, including the one John Law was involved in, has taught us that these vast powers must be regulated and managed. And that was a lesson that we forgot in the period running up to the 1970s. Today, power of money creation and rate fixing is restored to usurious rentiers, of which Mr. Bob Diamond and his friends are just a small part. And what's really tragic is that we're now back to where we were before 1694, when the rich lord of the manor, sitting at the top of the hill in his castle, having pillaged and robbed around him, had accumulated a massive surplus in the vaults of his manor, and a peasant comes up to him and says, "Can I have some money, please? Because I want to expand my field of corn, because I might be able to earn more money and keep my family that way." And he says, "Yes, you can have some money, but this is the price. 15%, pay me back with at least a big share of your corn output every year. And by the way, I notice you've got a beautiful daughter. Bring her up to the castle." We're back to that kind of economics, because these guys now have control of money and are hoarding it and not lending it into the real economy. This is why we've all, from Keynes through to Abraham Lincoln and so on, insisted on the euthanasia of the rentier, because of their insistence on extracting rent and additional assets from the free good that is money, multiplying the rent on units of money, and in the process building up vast unpayable debt, vaster space, which is expensive debt, and in the process destroying the economic activity necessary with which to repay debts, with which debts have to be repaid. So we've now got a system where the reckless, unethical and globalized activity has broken the British money and banking system. The banking system is essentially a lending machine. It is now totally dysfunctional. Instead of lending into the real economy, the banking system is borrowing from the real economy. Banking has been turned on its head. It is now a borrowing machine, not a lending machine. borrowing from the real economy. We know from the Bank of England that net lending by banks has been negative since April 2010. So we are repaying our debts, repaying our mortgages, we're depositing our surplus and our profits into banks, and they are not lending into the real economy. They are broken. They are not functioning as a banking system should function in a healthy economy. So I want to move now again to the rate of interest. We know from historically that rates of profit for firms are on average no more than 3% a year, year on year. Some years people make more than 3%. I noticed that, was it Barclays has to make 20% a year. There are some firms that are obliged to make up to 20% a year in profits. This is unsustainable, it's not possible. On average, over time, 3% is the average rate of profit. So to stimulate investment, research and innovation, interest rates should never rise above 3% in real terms. And Keynes argued that no one can foretell at what point the rate of interest will reach its equilibrium level, but it is highly probable that the equilibrium, and by that I think he meant full employment and so on, is not above 2% for long-term gilt-edged investment and may be appreciably less. Ask any entrepreneur. Ask Mr. Watts inventing his steam engine. He don't want to pay more than 2.5% a year on this risky investment, which may turn out to be extremely profitable and useful to society, but which he's at the moment unsure of. And then I want to show you this chart, which I love, which the Financial Times produced. It's very hard to get charts of real rates of interest, and I would love to find a really brilliant economist to work with me on that. But this is a chart of base rates, so therefore not real rates into the economy, from 1914 through to 2009. And it's a beautiful chart because it illustrates the point so well. So we have this massive increase in interest rates up to 8%. Now, of course, this is also not inflation. This is not inflation proof. So, you know, inflation may have been quite high, but the fact of the matter is that base rates were at 8%. I hate to think what real rates were at this point as we approached the crisis in 1929. And then in 29, the central bank governors bring rates down dramatically, and they then creep up again in 1926 and so on. In 1933, at this point, Keynes effectively takes charge of the Bank of England and the Treasury and advises and uses liquidity preference theory to persuade them to issue bonds across the spectrum of maturities in order to lower rates across the board. And the rate, at a time when Britain borrowed more than it had ever borrowed in history before, is at 3% or lower. This is during the Second World War. Except for this moment when I think Keynes went to Washington and Morgan came back from where he was recuperating in a Swiss hospital somewhere. But anyway, the fact is Montague Norman so it would have got in there. So, but the fact is he kept them that low, and they stayed relatively low after he died until we get into the 60s and the 70s, when we have the deregulation of credit creation and the deregulation of the fixing, when LIBOR becomes the thing. And then we have Mrs. Thatcher and Reagan in 79, and we see what happens. Interest rates are allowed to rocket to very, very high levels, and they're used to break the labour movement on the one hand, but also to benefit her friends in the City of London. And it's deeply ironic that it does benefit her friends in the City of London. They do extremely well out of the whole process that happens after credit competition and credit control is introduced in 1971, and credit creation and pricing of credit is liberalised. They do extremely well. But someone she admired enormously, Freddie Laker, who worked in the real economy and who was deeply innovative and entrepreneurial, started us off on low-cost airlines, challenged British Airways, did all the things Mrs. Thatcher was so proud of, took on the big, bad guys. He was bankrupted by Mrs. Thatcher's monetary policies. It's really deeply ironic, but it tells us something about what happened to the British economy at that point. Of course, he had other problems as well, but mainly his real problem was that he had to borrow very large sums of money to keep this show on the road as he took on British Airways, and interest rates as we saw, were going ratcheting up there and eventually broke the back of his enterprise. Sorry, I wanted to vacuum cleaners. So I want to show here that I want to disagree with so much of the literature about how interest rates, and including Mr. Greenspan argues this, that interest rates were the cause of the crisis, that they caused, the low rates of interest were the cause of the crisis. And I want to disagree with this very, very strongly. These are policy rates from 1999 through to 2008, and I want you to think of these rates as daggers pointing at an enormous balloon of credit. And when the dagger gets sharpened up here, it bursts the balloon of credit, and the crisis breaks. So this is the dot-com bubble, and this is Mr. Greenspan, you know, ratcheting up interest rates for whatever reason he gave, and those high rates then break that particular bubble. And then he dramatically brings it down, desperately, because the American economy is contracting massively. This is the only instrument he has. And then everyone says, well, that created a lot of debt. Sure enough, it did. It did encourage everybody to go out and borrow crazy money. So what he then does from 2004 onwards is to ratchet them upwards. So, you know, we have hairdressers on $7 an hour in Michigan who are desperate for somewhere to live, have nowhere to go to live, take out a loan, a mortgage for $300,000 in 2003, and then by 2007-8, you know, the cost of that mortgage has become unbearable to her, and she defaults on her mortgage, and she's at the bottom of this upside-down pyramid. But this is the dagger pointing at a vast mountain of credit, and it breaks it, in my view, because the debt becomes unpayable. It just becomes unsustainable. This is, and yet if we look here again, this is LIBOR, we see precisely how this happens. Again, here we go, you know, US equities bullish, the bubble, we have this massive bubble, we've got easy money, easy but dear money. Look how dear it is relative to base rates. This is very dear money. I'm borrowing huge sums of money at a very high cost, believing that my rates of return are going to be well above 3% or well above 7%, and I'm going to repay it. And then eventually the day dawns and I can't. So the dot-com bubble bursts, and then we do the same thing again until 2007, when the whole thing comes sliding down. So the LIBOR scandal, in my view, is just a symptom of a broken, out-of-control global financial system, which has at its heart easy but very dear money. So that's all very well, you'll say, and I'm running out of time. How do you fix this thing? Well, I've got big ideas, and they're so big, and I'm squeezing them into the last few minutes of this talk. So I'm really of the view it's not really complicated. I think the Bank of England has to regain its role. It has to once again take control over interest rates. It has to ensure that interest rates for the entrepreneur wanting to invest long-term in risky projects, wind farms, or whatever it takes to transform our economy, the Bank of England's got to be there making rates sustainable for that entrepreneurial effort. It's got to work, it's got to understand that it must work in the interest of both industry and labour as well as finance. And it must influence these rates by issuing a complex funding offer, making a complex funding offer with a range of bonds or paper at all maturities, short and long, safe and risky, to meet the liquidity preferences of savers and investors. And to do so, it has to cooperate with the government's debt management office. Gordon Brown, in his wisdom, separated out the debt management office away from the Bank of England and away from the FSA. These things have to be brought together again to enable these sorts of bonds and maturities to be developed. So the Bank of England thinks that its role is to set interest rates to keep inflation low, to preserve the value of your money, it tells me on its website. And the Bank of England assesses the health of the financial system and works with others to keep it stable, it tells me on its website. Above all, it issues banknotes. Now, how many of you use banknotes? And how many of you got banknotes in your pocket? But you've all got credit cards, Oyster cards, or whatever. We don't use banknotes anymore, virtually. And yet, you know, that it sees itself as having that as a major role. And of course, we want security features on our banknotes to make sure that our money is the real thing. But above all, we want our banks to be the real thing, and the Bank of England has to get it. So we need a whole range of policies, and for me the most important one is capital controls, and I know that will be laughed out of court by some, but I can see it coming, it's inevitable, and we will get capital controls, but we cannot manage the rate of interest for this economy appropriate for our entrepreneurs without capital controls. And they're going to return sure as money. And don't, for goodness sake, tell me that it's not possible. I went to Iceland, met with the Prime Minister's office in Iceland, and both that small country and the IMF jointly together managed capital controls in order to manage the restoration and recovery of their economy. And they had a hard time doing it because their people are as digitally smart as we are. So we need limits and regulations of speculative activity on banks. We need to generate income, above all, to pay down debts, especially in Britain, where we have masses of private debt. We can do two things with that debt. We can write it off and say it will never be repaid because it exceeds the economic potential of the economy. And we're going to have to do that. We're going to have a jubilee and admit some people bankrupt, they will never pay. But if we were really sensible, if the banks were sensible, they would support the government in creating economic policies which generate income. And the best way of generating income is through employment. Enable people to earn some money, and you know what? They might pay back their debts. They may pay down them. Make them unemployed, and they're not going to pay their debts, and the banks are going to be further bankrupted. So we will require that, as well as an active fiscal policy by the public authorities. And then to stimulate investment in projects that will both meet society's and the ecosystem's needs and revive the private sector. The private sector is begging the government to do something, for example, about construction. So we want to recognise, above all, the scale of the crisis. I don't think people understand quite the scale of what we're going to, what the mess that we're in. It is in the most, I would hate to have to be a global banker. I would hate to have to be the master of the universe that has to fix this mess. It is a mess. And untangling it at global and national level is going to be extraordinarily difficult. We have to recognise that the monetary banking financial transmission system is broken. If we go around pretending it's not broken, we go around pretending that it acts as before, we're not going to fix it. We have to recognise the scale of private debt. And we have to recognise that because the private sector is so indebted, it cannot lead the recovery, and that we need action, therefore, by public authorities. In other words, we have to take him seriously. We have to recognise that there is a danger that some governments will endeavour to reassert a grip over their economic affairs. Thank you very much.